My name is Pradeep and I represent an organization called Avishkar. We we are an impact investor, if you might want to call us that way. And we have been we have started about 2001, 2002. We have made around 50 odd investments into so-called social enterprises across agri, food, health, education, finance and inclusion, microfinance, renewable energy, etc. So we advise about 4 funds right now, hopefully a 5th fund very soon. That's about us.
Hi, I'm Sheena Chhabra. I head the Health Systems Development Team at USAID India. And in terms of USAID works in various areas, including clean energy and environment, in early grade reading, in food security and health. I myself am dedicated to working in the health space. So a lot of the examples and what you'll hear from me today would be the work that USAID is doing, especially with the market-based partnerships, and sort of really looking at the whole of market approach, looking at what's the space for public sector, what's the space for CSR, what's the space for market-based approaches in health.
Well, great. I'm Charlie Kleisner, and this is the time when I actually need to do yoga. So excuse me in order to wake up and make sure that I'm fit for this conversation. But since we can't do this, I try to do some mind yoga with you. And so Lisa and I, we immigrated to Silicon Valley in 1986. I'm from Austria, and I have a PhD in computer science. And so that was one of the causes why I had a very successful career in Silicon Valley as a chief technologist, and with 3 successful startups. The first one was Next, which Steve Jobs sold back to Apple. The second one was Datamind, which we sold for $400 million to Epiphany at the time. And Ariba, a business-to-business e-commerce company, which just was sold to SAP for multiple billions of dollars. So when you do that, then the investors in your companies become really rich. But not only the investors, but also us, because of course we had shares in the companies that we worked for. And that prompted the significant question of what is the meaning of wealth? And I'm very pleased that Lisa, my wife, whom you got to know this afternoon, and I are on the same page on that one. Otherwise, you could imagine the fireworks. But in any case, so the meaning of wealth is to make a positive contribution to humanity and the planet. The meaning of wealth cannot be to create more wealth without a positive impact. It does not make sense. And so to that end, we talked about how to increase impact. We are on the verge of changing systemically, to Kavita's point, how capitalism actually works, to make sure that impact is at the center of everything that capital makes, positive impact that is. To that extent, we created our foundation, KL Felicitas Foundation, which now is 100% into impact investing. We'll talk about that maybe a little bit this afternoon. And we created organizations both on the supply and the demand side of capital and intermediaries to make sure that we participate actively in the transformation of the unsustainable old system that the new impact system will feast upon.
Thank you, Charlie. That's a hard one to beat. So, I'm Karthik. I work at Omidyar Network. For those of you who are not familiar with what ON does, we're an impact fund which invests both for-profit and not-for-profit. And we have certain key sectors that we look at. And I'm sort of honored to be on this panel and have a few questions raised. I think a lot of these questions come up in our day-to-day sort of work. And I know a lot of the audience as well has challenges in some of these areas. So I think the way we're planning to structure this panel is we have a few questions which we've laid out, which we believe will be of relevance to the audience. And we'll talk about that maybe for about 30 to 35 minutes. And I'd like to give a lot of time for Q&A because I think there may be specific issues that each of you are grappling with, and maybe you'd like to sort of think about how people on the panel think about that as well. So if we can start, I think, Sheena, maybe we'll start with you as well. So the topic is funding to accelerate impact, and the description says grant making is sort of growing in India. So, and I thought it would be useful for you to talk about USAID, its approach, the role of the grant maker, how you engage with the donors. So maybe if you could sort of share some thoughts on that, that would be good.
Okay. In terms of, specifically what we are really looking at here, to sort of really catalyze private sector engagement in terms of, and what kind of role that the grant maker can make within that. I think in terms of our own experience, and that's something which I think there are some of the other development partners and foundations are also looking at. There is, when we look at either new products or new services, or we look at in terms of underserved markets, that's something which to really expect that you're going to make profits at the beginning, it's not going to be possible. So I think part of the role that a grant maker and a funder can make in that kind of respect is to look at social investment which is time bound, and sort of with that try and catalyze the private sector engagement in a manner where you can sort of look at either reduced margins or look at in terms of getting them to really work in underserved areas, because if you're talking of social impact, there might be profits at different target segments, but if you really want that the impact should be targeted at, say, rural population groups or base of the pyramid population groups, etc. So with the kind of donor investment, and I think that's something which we have done in our health portfolio, where we have looked at how do you sort of look at priming the market, look at some of the market shaping and market building activities and catalyzing private sector. A lot of times here it may be, in terms of for creation of demand, looking at really supporting generic consumer awareness work. I think that's something where then you sort of create the pull for the products and services, where then there are volumes which, in a few years where you see that volumes are such that then the private sector can come in and it becomes much more meaningful and they can be engaged in a sustainable way. So that's the other area where we have worked. The other third area, I think, which is really important is, we were talking of pipelines in the morning and really generating a pipeline. And so the space that we have also worked in is to look at, specific models and development of the models, where you look at the conceptualization, the design of it, and actually developing the proof of concept, and what works, what doesn't work, and so that, and sort of getting your matrix around that, getting the different players that need to be there. And after that proof of concept is established, that's something which then, in terms of there can be other funding that comes in to really take that to scale. So that's the other area. And lastly, I'd like to talk about, in terms of really as a grantor, we've talked about when we look at new enterprises, in terms of helping during the phase of, and providing targeted technical support, really providing the sector knowledge, looking at business support that may be needed, and really funding for that. So, and having platforms and sort of contributing and supporting platforms which help in that knowledge sharing, so that there is, in terms of the costs for really looking at and taking some of these models to scale, that can be reduced, in terms of discovery costs for new partners can be reduced, different partners can be brought to the platform which normally one would not, so really helping, support those kinds of platforms. So those are the different ways in which we think that in terms of grants could help.
So in terms of the grants that you give, I mean, there are two views on this and pretty divergent views. One is that you just give the grant and let the enterprise run its show. The second one, of course, is a more directive sort of thing, that you give the grant and you actually control what the organization is doing, or at least direct what the organization is doing, and then sort of try to push it forward. Where would you see USAID and sort of similar donors placing themselves? How engaged are you with the portfolio?
I think we have various mechanisms that we look at in terms of the way we provide support, and depending on the kind of mechanism that we choose, the level of engagement may vary. But ultimately, let's just step back and say, what does a donor like USAID want? If I look at India, I'm again going to take the example of the health sector. we are pretty much mandated in terms of the kind of funding support that we have, the kind of needs that we have. We are really looking at working in the space of looking at ending all preventable child deaths and maternal deaths. We are looking at the space of really mitigating the impact of HIV as well as TB. So those are areas in which we are providing support. So I think a lot of it is in terms of the way we seek partnerships and in terms of our mechanisms. The way we tend to sort of outline is what are the results areas in that. And in that, then we solicit partnerships and then review what we get to sort of say, okay, this sounds, these kind of pathways will lead us to these kind of results, and therefore we would fund those. So that's the kind of analysis
Similar
that we
to
do.
the Adolescent Girl program that you have with
Absolutely.
DASRA as well. Okay.
Absolutely.
No, fantastic. So Charlie, you come from a very international perspective, and you looked at various countries when you've been doing your grant making as well. Could you maybe share some thoughts about the layered capital concept that you are very passionate about, and some thoughts around how hybrid financing can actually work? And that.
Yeah, great. So we are one of these investors who actually have 3 types of capital available in our toolkit to maximize our positive impact. And as a foundation trustee and founder, we can give out grants, right? But we can also do what's sometimes referred to as subsidized capital, maybe capital that's not as fast with the returns or demanding with the returns as commercial capital, for instance, right? And then we have investment capital, the 3rd type of capital that we deploy as well. And we love to figure out deals where actually the combination of layered capital, as it is sometimes called, different layers of capital, different blends of capital, together have a bigger impact as if you only give grants or only subsidized capital or only investment capital. So when you think about the opportunities on that one, right, then the incubation and acceleration of social enterprises is one area that actually demands all 3 types of capital, and sometimes in very different mixes and blends. And so DASRA Social Impact is one of these accelerators and incubators. Lisa and I, we founded a company called Social Impact International about 8 years ago, one of the first incubators, which now migrated into an incubator of incubators. So we not only we helped DSI get off the ground as co-founders of that, but also an incubator in Vienna, Austria, for Central Eastern European entrepreneurs, and in the middle of Pacific, Hawaii, where Lisa is from, for entrepreneurs from the island who actually do island-specific and culturally sensitive enterprises for that economy. And so if you think about what it takes for these incubators to be successful, they need to provide at least the following 4 services: peer-to-peer learning and access to specialists, right? Mentoring, preferably with people who actually know how to build businesses, access to capacity building, as was pointed out before, and access to capital. And so this is not something that the entrepreneurs can actually pay fully loaded cost for. And therefore, it's a very leveraged investment with subsidized capital to provide grant capital and maybe some investment that doesn't materialize with respect to financial returns for some time to get these incubators off the ground. I think that there is a lot of international capital that come in to complement local capital to actually do these. What's absolutely necessary these days, however, is to really create investable entities, investable entrepreneurs. So we need to hold these incubators accountable. It's not good enough to just do good, so to speak, and there's nothing else nothing investable there, right? And so I think that that's a challenge, for the space, and there's so many incubators springing up and getting so much grant capital that actually is diluting the impact of that grant capital. So finally, maybe as my starting remarks on this one is, as an international investor, well, India doesn't really make it very easy for us. And I mean, these social entrepreneurs, they actually need term sheets that make sense for them. A lot of them, as was pointed out, don't need normal equity. They cannot really digest normal debt because they don't have the collateral, they don't have the cash flow to serve that. They don't create the value for any exit, any potential exit for equity investors. Yet, as an international investor, I'm only able to do one type of term sheet. Now, if you want to really turn off, international capital coming in, that's one way of doing it, right? And I suggest that we need to work on really enabling us good-intentioned investors to collaborate with the capital in the room to augment the impact that we can have together.
Yeah. No, thanks, Charlie. In fact, just in terms of context, I'm a lawyer myself, and I used to be a partner at Amarchand Mangaldas before this. And I see, and in fact, it resonates with me as well, because a lot of times what you see is a Series A term sheet being used for a grant, and you're like, this is in no way connected to this. And even if you're doing early stage investing or all of that, you're using a Series A term sheet, and you're like, shouldn't the diligence and documentation for an early round be much lighter? So I think I see what you're saying. So moving from international capital to our domestic capital, one of the points which I wanted to sort of make is that we see a lot of international grant coming into the country, but I think there is a need for more domestic grants being available. So I think that's where we can also sort of help accelerate that space. But moving on to just the for-profit side of the business, unlike the layered capital side, Avishkar has been doing a lot of work on that, and they've got several investments in that space. So it'll be good for Pradeep if you could just share a few of those things, and how do you take your high-risk bets in that sense?
Yeah, I think thanks. And let me just say that over the last 11, 12 years, of the 50-odd companies that we exist today and about 9, 10 odd exits that we have made, we have not given grant to even a single company. And we haven't taken grant ourselves. And although we were a startup ourselves 11 years back. And I think, and therefore it becomes important to, I think, contextualize this whole discussion about grants and see grants are needed in certain places in certain times for certain types of enterprises. And I think, and also taking off from where Charlie left off, and he's from Silicon Valley. So let me just take let me take an example from there. And my partner and colleague Vineet, I mean, when he always says that Avishkar, for example, the fund which we represent, we believe that within the situation where we are in countries like in India, the businesses we invest are businesses what we call as a need-based business and not a want-based business. Now, what is the definition of a need and a want keeps changing. I mean, like my cousin tells me that his son says, it's my birthright to have a WhatsApp on my phone. These days have become some sort of a fundamental right, but there are lots of people who have fundamental rights about not having access to education or sanitation, etc. So in that sense, we are slightly more old school or more traditional, that we believe that, and once you start from that perspective, that if you look at needs are what is more required in certain situations, in context like in situation like in India, and then you then start debating, now who are the entrepreneurs who are best equipped, or who are the companies or promoters who are best equipped to handle this opportunity in a country like India. They are not the guys who have an extremely highly qualified in terms of academics, etc., but they are people who have a bit of that, a bit of understanding of the local context, a bit of understanding of how these things tend to behave when you are in a certain size and how do you scale, etc., etc. So as an early stage investor or a venture capital investor, if you were to call it, the scale replicability therefore becomes very important for us. And therefore positioning grant within this whole context becomes slightly more trickier, because what happens is entrepreneurs always like money that is be given to them with no expectations back in a certain sense. Once you start creating this concept of doing that, and then you are actually not doing what is the right thing for these companies and the entrepreneurs as they scale, and as when we tell them that when you go out and raise more capital, because your limitation is not here, your limitation is not here, the whole country probably is where you should be targeting, which means that when you do in year 1, year 2, year 3, you need to build in a culture of governance. You need to build in a culture of understanding what it takes to scale and evolve. And organizations need to evolve as they themselves grow up. So, and that's a role that we as an investor try to play there.
But how would you take those initial high-risk bets? What would be the determinant factor for you? I mean, where would you say that? So, I mean, the question for Charlie as well as you is, I mean, you see early stage and you see growth. Where is the money needed the most? Where would you put your bet on, and how would you sort of proceed on that?
I think we have always put money on early stage, and that's just because the opportunity is so enormous in countries like India, and some of these countries surrounding India is equally huge opportunity. And the reason why we say early stage is obviously it makes, we believe it makes both huge commercial and huge impact sense or social sense. And I think we did an analysis, and something that we have been working with our partners and on trying to see how do funds rate each other, rate themselves. And rather than looking outside, let's start from looking inside. Let's start at what we have done. I mean, if you ask 10 funds and say, how do you rate your performance? I mean, they'll say, I've invested in 5 companies, and each of these companies have reached out to 1 million people like this. This company has reached out to 2 million toilets. This company has done 3 million loans. This company has done 5 million solar lanterns. But what we are missing, what we have found missing is what is it that you have done from your side? Because these are achievements of your companies. I mean, these are not achievements of you. I mean, you have just given them money, and they have gone out and done all these things. What is it that you have done? Can we put the mirror back on ourselves and try to see how naked are we? I mean, we can't shine in the glory of what our partners on the ground have been doing. I mean, they have been doing great work. Can we shine in our own light? So when we turn the mirror around and try to shine on our own light, we say, have you taken the early stage risks? Have you gone in early? Have you gone to difficult areas? Have you invested in the form like a real partner to your entity? And that's what we have been trying to do. And I think when we did our analysis, we discovered that over 94% or something of all our companies, we were the first investor. Almost 60% of all our companies would never have come into existence had we not been around. And they were complete novices, and we created them. There was a company on which today morning we had a call on an investment committee approved for a further round of investment. This company was just not existent had we not gone in there, and today he has raised 3 rounds of capital after that. And I think that is what we mean by turning the mirror on oneself and calling ourselves,
in fact, this
and
is
putting ourselves accountable.
Yeah, no, I think that's a great point. In fact, it's a good segue to what Charlie has been doing at the Felicitas Foundation as well. And the KL Felicitas Foundation, along with Sonnen Capital, has come out with a report to measure their financial returns against the impact. And we have a copy of the report as well, and it's available online. So feel free to sort of go through that. And maybe if you want to just talk about it in like two minutes, because I think we're running out of time as well.
Okay, well, everybody in the industry says that you have to take a financial haircut if you want to do impact investments. And Lisa and I set out a few years ago to actually dispel that myth. And we have been successful in doing that. We just published together with Sonnen, our investment advisor, a report that shows the financial return over 7 years audited about all of our impact investments in all asset classes vis-a-vis industry standard benchmarks. And in most of these asset classes, we outperformed the non-impact investments, all the way from cash, about 50 basis points, to global public equities, about 5% over time, to hedge funds, even so we only found one, and that one is a long short where we actually short the non-sustainable businesses, which is fine if we make a little bit of money when they go under, right? It's very much value aligned, all the way to all other asset classes as well. And what that prompted us to do is actually to collaborate with other investors, including within the Tonic network, to really syndicate capital amongst like-minded people into funds and into these deals, also growth deals. And now we're spinning off the 100% Impact Network, which is actually asset owners who made the explicit commitment of aligning 100% of their assets to positive impact across all asset classes. So soon, we'll have dozens of these portfolios that actually show that you can create a full portfolio across all asset classes with impact and financial return. That will then lead finally to the possibility of changing the financial industry, which I set out to tell you that that is our objective. Because if we can show that there's a dozen $500 million portfolios that can do what we did with $50 million, at that point in time, there is no more excuse that this cannot be done.
Yeah. Well, thank you, Charlie. I think that's a point well taken. Sheena, just the last question for you before we open it up for Q&A is, in terms of USAID and how you look at it, it's basically federal money which is coming in and working in the private sector. So what are your thoughts on this, and how do you see, like, for example, in an Indian context, we have a lot of money coming in from the governments as part of the CSR initiative as well, which has recently been notified as well. So that's going to be a lot of public money as well coming in. So where do you see this panning out, and how would you say you'd like to see it shaped?
I think in terms of, from a USAID perspective, what we are, if we really look at, and I'm going to again come back to health sector, the space that I'm most familiar with. Really all donor, forget about USAID, but all donor money put together is less than 1% of the total health expenditures in India. So in terms of, it's not like, in terms of it's huge money which the donors driving the health agenda, for instance. So if I'm looking at health impact here. But I think the way, what we are looking at is in terms of really looking at this as catalytic investment from USAID perspective. And as I said, if we sort of really look at the whole of market approach, then I think the points that one needs to see is if we are looking at, say, the issue of child survival, for instance. What are the bottlenecks that really exist? And therefore, what makes sense? Is it an early diagnostic that needs, or it is the point of care treatment that is needed? Is it that you need to have access much more, and work on last mile distribution? Is it consumer awareness? So looking at all of this, I think one needs to then say that what is it that would be needed? Is it in terms of really access to finance that's needed, and therefore sort of we stimulate and work in that area? Or is it in terms of really in terms of how we look at incubation and innovation to we have all the proven tools, and we know what are the points of interventions in terms of technical interventions, but it's really the delivery that's lacking. Yeah. So what are the innovative models in which you can really get the processes and the delivery improved? So I think it's, so a lot of it is, the way we are approaching is to really look at and do a whole bottleneck analysis to say, okay, what are the points of interventions? Coming back to your question on CSR, we think it's a huge opportunity in terms of where CSR can play a role. And in terms of especially the kinds of spaces that I was talking about, whether we look at, child health, maternal health, we look at girls' education. I think these are areas that have been identified. And the way that what we can see is that there's a lot of, in terms of, I think donors like us can really play the role of where there is that knowledge management and technical support that's there, sharing that so that the CSR resources then can be channelized to more effectively, really deliver the kind of impact that we are looking at. And I think that's the kind of role that we are seeing for ourselves that we can help play and catalyze.
Sure. No, thank you so much. I think I'd like to sort of open it up, and if there are specific questions which people have in the audience, then we can sort of raise it. I think there are people with mics around, so if you could just raise your hand, then we could just. And if there are no questions, then we have enough of our own. So.
Okay. My name is Susanne Grossmann. I'm from Dalian Foundation. Hi, Pradeep. My question is actually, Charlie Clisson, you have mentioned actually the benefit of having several layers of different capital. Do you or anybody else on the panel, do you also see tensions between the different types of capital. I was just thinking of a concrete example. There are social entrepreneurs which try to establish profitable business model in the vocational training space, but there is also a lot of grant money flowing into that sector. So there is, in my view, a certain risk of crowding out also social businesses. So I think, and with the CSR money coming in, isn't there a certain risk also that there can be a competition?
Do you want to take it first, Charlie, and then move on? Or Pradeep, why don't you take it?
Yeah, I can take that actually. And I clearly don't think that there is a risk of crowding out at all. And I think the contours of how CSR is going to be playing out is completely unknown. I mean, I'm not sure if it's yet been notified. Maybe you say it's been notified.
Yeah, it's been notified last Friday.
Oh, okay, so which is great. So, but we still do not know even after this how it's going to get played out. And I think the important part even after that is building replicability and scale. I mean, once what happens is, if somebody is known that if this is going to happen, where do you go beyond a certain level? And I mean, if you are dependent on a source which you're not sure, are you attracting capital or are you pushing capital? I mean, I think the difference between the two is, if you are an organization that is attracting capital, then you have demonstrated a certain thing, that you already have a certain advantage in terms of market advantage, and then you attract capital. Whereas what CSR can do is triggering that starting, but once you reach a certain stage and you need to evolve into an attracting capital stage, that's when you start getting that, when you build and then you grow. And I think CSR money, while couldn't be a great trigger, I think unless we are able to build on and structures that build on that, we will only reach so much and not beyond.
So I have just one point on that. In fact, as at ON, for instance, we have two entities, Anudeep and iMerit. Anudeep is the not-for-profit entity, and iMerit is a for-profit entity. Anudeep does the training, and iMerit recruits, and iMerit is effectively the BPO entity for it. And both of them, I mean, first of all, hiving the for-profit entity out of the non-profit has its own challenges, but once you've made those investments, they're both separate entities. So when you say that there's an overlap of the hybrid financing as such, the tendency is then you should make sure that each of those entities run as separate things. Because the moment you sort of have that overlap, then that's where the stress and strain starts coming in.
Yeah. I think some of the,
Please.
Can I add? Sorry. I mean, some of the companies that we have seen in our portfolio, Suzanne, is that enterprises who are not able to grow beyond a point then try to, I think it's more a cultural aspect and it's more of a behavioral aspect as well. I think that once they start feeling that there is some other kinds of monies available, and then you start relying only on that, and then you automatically start being or behaving or being seen as building organization, and then you start regressing in a sense, in a way which may not be value add for all people around, and then at some point it just takes off. So I think it has to come in at the right time and for the right causes. The same organization, you give grant money for building, say, I'm designing a new system which will probably mean, and the designing phase takes say 1 year, 2 years, that's where you probably can give a grant, but not for your core activities. And I think that's it's slightly subjective sometimes, but I think it's important to make that distinction.
Sure.
I actually think that is the much bigger risk, that social entrepreneurs get handed grants and they should do a social enterprise because there's no reason, and then they will fall down, right? Because they are not having to implement the processes to be responsible in managing their business, right? And that, I think, is the much bigger challenge than the other side.
Any other questions? Please.
In my experience, until a few years ago, Aavishkar was the only game in town. Everybody was chasing Vineet. Anybody came with money would go sit at Vineet's feet.
I thought it was the other way around. Vineet always said he used to chase capital.
He was, chasing capital. But capital, when they came in, wanted double bottom line. There weren't any deals.
Correct, yeah.
Now, of course, with Dasra, IIM and all having competitions and all, the pipeline is slowly changing, but not fast enough to keep with the capital.
So the question being?
Is this true, or has the dynamics changed now? There are many more deals than money. Double bottom line, there is some exit and all that.
Huge change. I mean, I can tell you that, I mean, just look at the number of new funds that have come out with. I mean, not just equity capital funds, but also debt capital funds, venture debt funds, huge change. I mean, it's just that, and look at, and most importantly, sir, the kind of entrepreneurs that have changed. I mean, 7, 8 years back, if you were to be called a social entrepreneur, then you would be probably 55 years old, and you would probably be somebody who has done this and who has been now wanting to lead a semi-retired kind of a life. That's not the case anymore. Now the people are seeing entrepreneurship as a real viable career alternative, which was not the way it was 7, 8 years back. And people today, young people, 35, 40 years old, working in large companies, MNCs, leave jobs and jump into entrepreneurship because they actually see this is a real career growth path for them.
Yeah.
And they see, and that's because they see a support system around it. Yes, and I think the more, and I think, and therefore investors also now having a higher benchmark, and they say, all right, now this guy is coming out of this, now should I give capital to him? So that is much more, I think there's a lot more activity, energizing happening at the ground, which actually is a good thing. And there are more players trying to get into it, of course, I mean, but like you rightly said, sir, I mean, the pace can get much quicker and can get much faster, but I think it's very different from what it was a few years back. So
I think we have time for another 2 questions. So, yes, sir.
Is the line between venture capital investing and impact investing getting blurred?
Yes, absolutely. So we fundamentally don't believe in that notion of augmenting something, in order to be called impact. Impact is what the intention is behind the impact. And if venture capital can get the returns with impact, they will come in. And so that's one side of that, right? And then the reverse is true as well, is that a lot of venture deals actually do have a lot of impact. And if it actually is above the threshold of impact investors, they will join these deals as well.
And in fact, venture philanthropy is sort of the new thing that they're talking about. So, yes, please.
Yeah, my name is Shrutapa Banerjee, and my question is to Charlie. Charlie, you spoke about impact investments outperforming some of the other investment classes. Yep. So my assumption is this would be for a period of time, 3 years or 4 years or 5 years. And presumably that consistency would also draw in. I mean, I can understand the quantum of impact investments increasing, but has it led to an increase in the number of investors who are investing in these asset classes, including mainstream asset managers and asset gatherers?
Yep.
Yes. So that's a very good question, and the short answer is absolutely yes. So we were surprised when we started talking to family offices that are capitalized up to $1 billion and more, right? How many of them now are actually actively moving into impact investing, and because of their size, obviously they need to invest in all asset classes. So they asked the question about where do we park our cash? Do we get the transparency with our cash that we demand with respect to our values, with respect to the multi-generational participation in the family offices? And they also then asked the question about, well, what about the commodities? Do we want to invest in commodities, in extractives that mess up the future of the planet, right? Especially the next gen. And they asked the question about, do we really understand the risk in the context of the impact that we want to make long term? And so it's very rewarding to see that this is going on. And it is not just a trend. I think it's the starting of a movement. However, this movement is limited right now to the people who manage the assets. Real people. It's not administrators. It's not people who have a job. It's people who express, and families, who express their values and intentions through the investment philosophy that they implement.
Since the Dasra team doesn't seem to be jumping at us, do we have 5 minutes more to take any more questions if people are interested? Any more questions?
So we have about 4 billion people in that group, 4 billion capital committed to that right now. I didn't mention any numbers. So that's getting to the point where the industry is starting to take us seriously, right? Which is nice.
Please.
Great.
Hi, my name is Mehna Sahi. Charlie knows me. So this question is, I'm sorry, you're getting left out, but this question is for Pradeep and Charlie. It's falling off the lines between VC and impact investing getting blurred. But the margins in impact investing still are not that high. I mean, the returns are high, but the margins are not. And so the ecosystem within that, like, in venture capital, you have your consulting firms, your investment banks also operating in that. It's a different ecosystem here. Right now, we only see in telecap working in this ecosystem, really. But what do you see? What kind of ecosystem will evolve in impact investing, maybe in India, which could support lower margins?
Pradeep, you want to talk about the council?
Yeah.
Yeah.
Yeah, I mean, we can, of course. But I think one fundamental thing which is also coming out from Charlie's study is that it's not actually true that an impact investor theoretically equals low returns. That's not true. And like Mr. Godrej was just telling a little earlier, that ROI is very good in education. So, and actually it's not true. And like in any investment space, there are some that give you very high returns and many that fail. So I mean, it's exactly like how you make in any normal case. I mean, it's like there's no difference at all. And I think especially countries like India or neighboring, whatever, I mean, we have a huge opportunity. I mean, we just have 1.3 billion people. Half of them, I mean, 90% of them don't have anything actually. I mean, just look at, okay, now coming to, I mean, we are trying to form what is called a IIIC, Impact Investors Council, Indian Impact Investors Council, of which I happen to be one of the members. Avishkar is also a member. So I think one of the studies that came out was, I mean, look at the per capita income. We always talk about $1 per day or $1.25 per day, but just look at it in an Indian context, it actually doesn't make any difference. And really, and in the IntelliCab you mentioned, they had done a study which said that over 86% of India, family income is less than 3 lakh rupees per annum. I mean, it's a huge number, and India is a low income country, and that's a fact. But I mean, you take this to Peru or Chile, I mean, obviously that number will be 5 times that number. So the contextualizing this whole debate and discussion becomes so critical that for an opportunity for an early stage, you want to call it venture capital or impact investment, whatever you want to call it, we can call it, but the opportunity is just so huge. I mean, especially you need not be in high tech, or you need not be, you can just simple things of providing toilets. It's a big business.
Yeah. Let me just expand on that quickly, and I think it's a great way of ending our conversation, or almost ending it. And that's where in the beginning, not the middle, in the beginning of this transformation, where merchant banks are becoming impact merchant banks, where investment banks are becoming impact investment banks, where non-impact intermediaries become impact intermediaries. And there's examples in each one of them in India and globally. And I'm very happy to see that, because we are all about systemic change, and I see that change is starting to happen right now, and we can participate in that.
No, thank you. I think that's helpful. Just to wrap up, sorry. Is it for Sheena?
Yeah. Yes. You make it.
My name is Sandra Shroff. My name is Sandra Shroff, and I would just like to make a clarification, which I'm sure is correct, for what Nadir said, Nadir Godrej. The ROI is positive on education. It may not be apparent immediately in the institution, but it is apparent for the family, for everything afterwards.
Absolutely.
So I mean, that is what I think he's talking. I don't think he's talking in the macro terms and not in the.
I entirely agree with you. I was just using that as an example, but essentially the point was, I also happened to see the Muktangan video after that, and there are some of our companies that actually enable to match up to that huge aspirational value that a lot of Indians have today in terms of aspiring to reach out to the next level. And there are so many people at affordable cost, affordable education. If you're able to provide it to them, you can make it up in volumes, not necessarily in margin per transaction, but in the sheer number that come to play. But I agree with.
I have one final question for
Sheena.
Yes. And so she's not left out. Is I mean, most of the discussion seems to be more biased towards venture philanthropy and that sort of thing, and not as much on grant capital. That came as a surprise to me as well, because I thought it'd be more around grant capital. But for you as a grantor, how would you look at a case? Would you look at it as, is it the social case which works for you, or is it the business case which works for you?
See, in terms of, as an organization, I think the social case is the bottom line that we need to deliver on for using the grant capital. But if you know, in this case, I think I'm just going back to Mr. Godred's point. In terms of, I think both social good and business good needs to be delivered, and I think there is a balance there, because unless what we are talking of in terms of social impact, if it's not profitable, it's not going to be sustained, and it cannot be taken to the scale that we are talking of. So I think that's something which is really very important. So one really needs to look at how do you maximize those results, take it to scale so that they can be sustained and you can get the social impact.
So you're saying USAID is going to get into venture philanthropy. No, but thank you. On that note, I think we'll end. Thank you to the panel as well, and we enjoyed the discussion. I hope you did as well. So.